So this webinar is going to be about tax advantages for passive and active apartment investors. We're going to go over both of these today. And before I get started, a full disclaimer here is that I am not a tax attorney, a CPA, a tax advisor, or anything like that. So this is purely for educational purposes. This is information that I have gathered and gleaned from my own consultants that I have that surround me, and also from some of the additional research that I've done on my own. So please make sure that you consult a tax attorney for your specific tax situation. This please do not take this as tax advice for you to just go off and do exactly what I say on here. So that is my legal disclaimer. And for those of you who don't know who I am, I'm this gentleman down here on the screen here, Dan Handford. I'm the founder of the Multifamily Investor Nation. I'm also one of the managing partners of a group called PassiveInvesting.com. And this group, you can find out more information about us here. I'm gonna go ahead and type into the chat box for those of you who are joining us live. You can find out more about us here. This is our PassiveInvesting.com website, where you can join us as one of our passive investors on some of our future opportunities. We actually have a section here on the page called Meet the Team, and you can see our team here. This is my name here, Dan Handford, and you can watch this video for further information about me when it comes to my background. So I am located here in Columbia, South Carolina, like I mentioned earlier on, in the green room, I guess, if you will, before we press the recording. I'm married, have 4 children. Right now, they're all under 10. So I have a 9-year-old girl, 8-year-old boy, and then a 4-year-old and a 2-year-old girl. And so we also have a standard poodle named Bella. So we have a pretty busy household, enjoying life immensely here in the Carolinas. And we primarily are acquiring properties in the Carolinas. We actually have an offering right now that's available. And on our website here, if you click on this little button that says current offering, you will find more information about this particular deal. And I'll go ahead and type into the chat box for those of you who are joining us live that link directly to that offering. If you want to take a look at it, you can take a look at it, watch this little video about the presentation, see some of the details here at a glance, and then also some of the returns we have available. We have 2 different classes available for this particular property. And then if you want some more information about the offering memorandum, this is open for accredited investors only. So you do have to be accredited to be able to invest alongside us. If you're not sure what that means to be accredited, please, reach out to us. Let us know that we can jump on a phone call with you to discuss kind of what that is and what these offerings are available. So, but this is a deal that's out of Cary, North Carolina, actually out of the Raleigh-Durham MSA. So you can find out more information by going there. If you just want to join us and hear more about some of our future opportunities, you can go to this button right up here, Join Passive Investing Club. And when you click on that button, there'll be a little simple form that you can fill out that'll allow us to be able to jump on a phone call with you to discuss your investment goals and see if our group is the right fit for you. So with all that said, let's dive into the tax advantages for passive and active apartment investors. So first off, we're going to go through each one of these questions that are on the list of things we're going to cover on the webinar today. And the first one here is what are the major tax benefits to multifamily investing? So I'm gonna kind of step back just a little bit and tell you a little bit about my background and kind of why I got into multifamily, and it'll help you understand some of the benefits to multifamily all at the same time. So I actually have several businesses that I own and I run, and it took me, several years to build them up. And I actually have a group of non-surgical orthopedic medical clinics that my wife and I built together and started from scratch. And we have built these, and my wife is the one who primarily does all of the accounting and things like that on the personal side for us. And I also have another business on top of that, which is a business that does it's a website called shopanatomical.com, and we sell all types of anatomy models like skeletons and skulls and brains and hearts and all types of models, plastic models, to colleges, universities, doctors' offices, and pharmaceutical sales reps across the country and around the world. And we've had that company for longer than the medical clinics that we have. I actually started that about 13, 14 years ago now, and it is a it is a consistent seven-figure a year business. And so with that business, and then also the medical clinics, we, every, quarter, my wife would come to me and she'd say, why are we having to pay so much more money in taxes? I'm getting frustrated with this. And I said, well, dear, I think that I always would say is dear, it's okay, because the more money you pay in taxes means that you're actually making more money. And although that was true, there's also things that you can take advantage of inside of the tax code that will allow you to reduce that taxable liability so that you can invest more of that money instead of taking it and paying more and more money into the government. And so real estate was obviously that key in that ticket. And about 3 years ago, I stepped out from being the CEO of the clinics. My wife and I still own them 100%. We stepped out to really focus on the real estate, the real estate syndication side, and the private equity real estate company that we created, that passiveinvesting.com, because I had a good COO at the time that I knew I could promote to the CEO position. And even though we still own those clinics, he runs the day-to-day operations. We have about 50 employees. We have nurse practitioners, medical doctors, things like that are working for us. And he manages all of that business for us. And I also have another team that manages the other business for us as well. And so I was able to take that time that I was spending going into the clinics and putting out fires and doing the management day to day, and really focusing it on the private equity real estate side of things. And that's where I started to learn about the passive tax benefits, but also going into the active side, learning more about the active benefits. And so I'm going to first talk about the passive benefits of of investing inside of multifamily syndication, but also just real estate in general, right? And then we're going to talk about this real estate professional to status so you can help reduce some of your taxes. I'll talk about a little bit about how to find a CPA, and then we're going to probably, in the middle of all of this, discuss how to offset other income with depreciation. That's what we're going to talk about first. And so on the passive side of things, you are typically only able to offset passive gains, okay, or passive income. And so as a passive investor, if you invest $100,000 into a property and at the end of the year, you show a loss of say $60,000 or $70,000 that first year, or whatever it comes up to be, right? Then you are able to take that depreciation loss. Obviously, you could offset the cash flow you received off that property, and you can also use that to offset other passive income. The only thing here is that you can't, the key word is passive income. So if you have a W-2 job, you cannot offset W-2 income with those passive losses. So you can only offset passive losses with passive gains. And so one of the key benefits of being an active apartment investor is becoming a real estate professional. And so if you can become a real estate professional, then now you're able to offset those depreciative losses into ordinary income. And so now you, as a real estate professional, and I'm going to talk about that in just a moment so you understand what that is. But as a real estate professional, you can now offset all of your income. And that's really where I wanted to be myself, is I wanted to be in that real estate professional status so I can be able to offset all of the income that I am generating off of the clinics and my other businesses so that I can reduce that taxable liability. And what you have to do in order to become a real estate professional is there's no like test that you have to take. You don't have to, go and get your real estate license or become a broker or anything like that. A lot of people have this misconception that you have to be a licensed professional in order to be a real estate professional. Now, the documentation requirements for becoming a real estate professional are really, really important, especially if you're working like a part-time job or something like that. Then you have to be able to document that at least 50% or more of, at least more than 50% of your working hours are in a real estate type of business and are on the real estate side of things as an active real estate professional. And that means you could be managing a portfolio of rentals. You could be, managing a portfolio of apartments. You could be doing a lot of those types of activities, which could classify you as being an active apartment investor or an active investor and become that real estate professional. Now, you have to, there's two different kind of tests with this, or at least more than 50% of your working hours have to be in the real estate profession. But then Also, you have to have at least 750 hours or more every year inside of the real estate business. And so if you take that 750 hours that you have to do annually, that's about 14, a little over 14 hours, like 14 and a half hours every single week that you have to focus on being inside of the real estate status, right? Or be on the real estate, business. And so if you're working a W-2 job and you're working 40, 50, 60 hours a week, it's going to be very hard for you to be classified as a real estate professional because you're getting this salary income. Plus you're trying to say you work at least 50% or more of your hours inside of real estate, which would mean you'd have to be working, if you're working 50 hours in your W-2, you'd have to be working 55 hours or 51 hours or whatever inside of the real estate. That's a lot of extra work that you'd have to do to put into that to be able to meet those two standards. This is not either or, you have to meet both of them. And so it can raise a lot of big red flags. Now, one key difference here is that let's say you are the sole breadwinner in your household and your spouse doesn't work right now. Well, your spouse, if you're married filing jointly, can become the real estate professional status. And as long as one of you is that real estate professional, then all of your income can be, both your income and your spouse's income can be offset by that depreciation loss as that active investor. So again, these are all really good ideas and great things that you can think about doing and implementing, but you want to make sure that you talk to a good CPA that understands this real estate professional status, right? And so if you don't have a really good CPA, which I'll be honest with you, when I got started in this, I had a really good CPA. I thought I had a really good CPA, but that CPA did not have a lot of the background knowledge in the personal kind of real estate professional status and depreciation, all this kind of additional stuff. And, right now I'm in 29 different passive syndications with 9 different operators, and I have a large tax return that has to be done every single year. And so it gets getting bigger and bigger and bigger because of all these passive, because of these passive as well as active investments that I'm actually doing as well. And you got to keep track of those things. And so I actually ended up switching to a actual CPA that understood this real estate side of things, this real estate benefit. And so that's kind of the next thing we're going to talk about here is how do you find a CPA that understands, right? That understands real estate. And it can be a little bit challenging. So if you've been to different types of conventions or events or things like that, you've probably have seen some real estate CPAs, booths or advertisements and things like that. So that's one way to do it. But also being active on a lot of the online forums and platforms like Bigger Pockets and Facebook. We have a closed Facebook group that we actually have for the Multifamily Investor Nation. And let me see if I can actually pull that up for you. So if you want to join us on there, you can. We have over 6,000, almost 7,000 people that are part of that. For those of you who are joining us live, I have a link here that you can actually click on. And when you click on that link, you will have to ask and request to join, but you can certainly do that. And when you request to join, there'll be a couple of questions they'll ask you to fill out and things like that. And you can just fill out those questions and we will get you access to this particular list here. So let me go over here. All right. So go on there and ask, hey, who are you using as a real estate CPA, right? And connecting and networking with other people in the space. And I have a list of, real estate CPAs that I've worked with or that I have actually interviewed with. And there's a couple of them out here. Let me see if I can give just a couple of websites out here for you so that you can reach out to these people. So this is one. It's called the Real Estate CPA. You can click on this link here that I'm typing into the chat box. Let me actually resume my sharing. So you can see it here, the realestatecpa.com. That's one. And again, neither one of these people are paid people. Like they're not sponsors or anything like that. These are just people that I know we've worked with in the past, whether it was interviewed or been on our podcast or been on our MFI and Summit that we do twice a year. And this next one is actually the CPA that I use. So I can send you the website information for him. You can just go to lanzerocpa.com. This is Ted Lanzero. He is a really good CPA. He's been really helpful for us. And so you can certainly, reach out to him, and I'll type his link into the chat box here for those of you who are joining us live as well. And so each one of those two gentlemen would be great people to work with to see if you could actually get a good CPA, right? And they might talk to you and say, hey, what your CPA is doing now is fine. You don't need us, right? So you can ask them those questions. And but a lot of times what I found is that your general CPA that usually does a lot of your taxes, a lot of times they might be really good, but they're just not good enough when it comes to the real estate side of things. And it's mostly because they're not doing it, right? And they don't have anybody in their network, if you will, that is actually doing it. So but it's definitely beneficial for you to do that, and reaching out to one of those CPAs to have them actually look at your tax situation and see if there's different ways for them to be able to help you with that. All right, so let me open it up for questions. I know I have a couple questions that have already come in here, so I've covered the content that I wanted to today. So for those of you, I had a couple people emailing me for that link again. So the link, if you go to our passiveinvesting.com website, obviously you can join us right here by clicking the Join Passive Investing Club. But our current offering is this button right here. It says Current Offering, and so you can click on that. And again, for those of you who are joining us live, let me just type that link in one more time here. So you can actually see that link for the investment that we have open. This is one out of Cary, North Carolina. It's a 5-year hold, and you can find out more information about it by going to that website. It is for accredited investors only, so feel free to, if you are accredited, to fill out this form to request access to this offering memorandum. That'll give you more details on this particular deal. So, so let me go ahead and open up for questions here. First question here is from Bob. Will K1 losses on multifamily syndication investments offset capital gains on the sale of a medical office that was being used as a rental? So to me, I look at that and I would say, if the medical office was used as a rental and you were not actively in that particular rental, you aren't like renting from yourself, then I would say, yeah, that would qualify. But again, Bob, reach out to one of these tax CPAs and ask that question, because that would be a simple question for them to be able to answer. Because to me, on the surface, it looks like if it's truly passive to passive, it's a rental property, and you can offset some of that from that as well. So just make sure you get some good answers and clarifications from an actual tax advisor and CPA. Swaddle has a question here. If I'm a real estate professional and only invested in 2 syndications passively, can I offset against my partner's income? So when you invest, even though you are a real estate professional, it is my understanding that because it is still a passive investment, you still can't offset that passive income with any type of ordinary income. But if your partner has other passive income, then, and you guys are married filing jointly, then yes, you should be able to offset that income that is coming in off the that depreciation loss from those K1s. Do you know if developing software that is used in the real estate industry, for example, working for CoStar, will qualify you as a real estate professional? I would say it would not qualify for that, because that is more of like an IT position, not necessarily actively managing real estate. So there are actual qualifications for what it is to be a real estate professional. And so you can look that up. If you just Google, real estate professional status IRS, there'll be certain guidelines as to what would actually qualify for that. So can you explain how you split the cost segregation depreciation benefits between GP and LPs on syndication? So this is pretty straightforward, Scott. It's a good question. It is a question we get quite a bit from our passive investors, because they want to make sure that they're getting the benefit of that depreciation loss, because there are some operators out there and syndicators that take all that depreciation loss for themselves and they don't pass that through to their investors. So it's a great question to ask. What we do with our group is whatever the ownership is in the entity, the depreciation loss is divvied up based on the equity ownership in the project. So that is how we do it at passiveinvesting.com, so that everybody gets a fair share of the entire depreciation off of the asset. Will K1 losses offset income from flipping and wholesaling if I am a full-time flipper / a wholesaler? So the question to that would be, it should. So you'll be becoming, depending, as long as you qualified for that, at least 50% or more, at least if more than 50% of your working hours are inside of real estate and you have at least 750 hours or more of time in the real estate business, it should. But again, I would definitely double check your entire situation personally with us, with a tax CPA that can really understand your whole situation to give you the best answer there. What is the difference in the total return between LP and GP for say a $20 million property? I'm not really sure what the question is here, because the total return between LP and GP is going to vary based on a lot of different factors and metrics. And it's not as easy as just saying, hey, what's the difference in the total return on a $20 million property? It could be 3%, could be 5%, could be 20%. So it just depends on some of the metrics that have to do with that particular property. Let's see, how many properties did you have to manage before you qualified? So it's based off of the annual or the current year. So it's not a matter of a number of properties that you manage or how long you've managed them. You could have one property and you spend 750 hours or more than 50% of your working hours managing that one property, and you could qualify in that year, and it's based on that calendar year. So, or your tax year, if you will. So I know some businesses have fiscal year, tax filings, not calendar year tax filings. So that would just change based on that. Does the high cost for preparation of cost segregation not negate the reason for doing it? So in certain situations it can. So like I would not recommend personally, I would not recommend doing cost segregation on a property if it was less than say $1 million, $1.5 million, because the costs are going to probably outweigh that. However, there are some smaller cost segregation groups out there that I've been told don't charge as much because the properties are just not that expensive, and that, for a couple $100, on some of these smaller properties, you can get a outside engineer firm to come in and actually do a cost segregation study on the asset for you. So that is definitely a benefit. But, our group at passiveinvesting.com is acquiring properties that are in the range of 20 to about 75 million in an acquisition. And so to spend, $5,000, $6,000, $7,000 to be able to have an outside engineer firm come in, it can majorly dramatically increase the benefit for investors to do those cost segregation studies. Let's see. Next question is, Roth IRAs are exempt from capital gains in the stock market. However, self-directed Roth IRAs are often subject to pay UBIT. What passive investment structures minimize these taxes? Paying these taxes seems to inflate the gains and point of converting into a self-directed IRA. So there are a couple of options for you. So I know a lot of people have converted their IRAs to 401ks, things like that. I'm not an IRA expert when it comes to whether you could do that with a Roth or, traditional and things like that. But there are some really good contacts. There's actually a contact. Let me see if I can find his information real quick, and I'll see if I can put it on the screen here. There's a company we've actually worked with quite a bit with our group for, I'll just type it. I'll just do this. So there's a gentleman by the name of Scott Maurer. He's actually with Advanta IRA. And he has helped a lot of our investors really understand a lot of these tax issues. And let me see if I can pull this up here. Yeah, here we go. Here's the website. So they're really good at kind of discussing what these issues are, but I do know that the depreciation loss could also help to offset some of that UBIT as well along the process, because we have a lot of investors that are investing via their IRAs, 401ks, and they don't really have it. We haven't really had a lot of issues with that UBIT tax. A lot of it's because our goal is to 1031 exchange these assets from into one into the next and things like that. And that's what, our goal is for that. So it kind of defers that as well. So here is this gentleman on the screen here. So you can see this on the screen for those of you who are watching the recording. This is Scott Maurer. He's the director of business development, but I've done some webinars with him. He's done some webinars with us, but he'd be a good person to be able to help to explain a little bit further about what would be the best options for you when it comes to avoiding some of those taxes, to be able to, increase some of your gains, if you will. Let's see. Do you have a spreadsheet or document you use to document your activities which qualify you as a real estate professional? So I do not actually have one of those, Julie, mostly because I am 100% full-time in this. I might say 95%. So there is 5% of my time I do have corporate meetings and things like that with my other businesses, but I'm 95% in this. So I don't have a lot of heavy documentation that I have to do with this. But for those who are working maybe another job and they're trying to do this at the same time, one of those CPAs will actually both of those CPAs that I recommended, this one here with Ted Lanzaro And also with the real estate CPA, they both have spreadsheets and forms and documents that you can use to be able to easily document that real estate professional status. Is it recommended or not that owner's consulting firm to have consulting service to the owner's real estate investment business? You don't necessarily have to have a consulting, service or business or anything like that or firm, but you definitely want to have a tax consultant for sure, but you don't necessarily have to be your own kind of firm to kind of consult and things like that with other people. That's what you're referring to. Let's see. How has your underwriting changed due to COVID? That is definitely a big topic. I'll get to that one at the end if we have some time. Okay. Let's see here. I recently did not qualify for a loan due to a higher DTI, 60% as a result of losses in my 2000 return. Any advice on how to find a balance between taking losses and making sure one can qualify? Well, I would tell you this. You have to find a bank that actually understands this real estate professional depreciation loss. Because I know people that have tried to get loans, even though they're making 7 figures a year, but they're showing 0 AGI, and so they're not able to show that they actually have any income. So you have to find a bank that understands that. And a lot of times it can be hey, I need you to talk to my CPA so he can explain it to you as to how we're doing things, because you can't always base things off of the AGI, because that AGI might be 0 because they're taking a lot of depreciation loss. And so they need to add that back in so that they could actually qualify for some of these loans. Can you clarify depreciation recapture at the back end? If one meets accreditation by net worth rather than income, there is less advantage for someone in a 22% or a 24% tax bracket versus someone in the 37% tax bracket. So you are correct. There's always, going to be a benefit to it, right? Of being able to not have to recapture. So if you have to recapture, so in our group, passiveinvesting.com, our goal with our group is to always try to 1031 exchange as much as we can into that next asset. So I say as much as we can because, we don't know if they're going to change the IRS tax laws and maybe even do away with some of that in the future. They've had some, I know, Joe Biden has had some questions or some thoughts and brought that up, that he wants to get away from the depreciation recapture. He wants to get away from the entire depreciation benefit as well as that 1031 exchange option. So there's a lot of things that are still up in the air right now when it comes to that. We're actually acquiring a property right now from a group that wanted to sell their asset between now and the end of the year so that they could take advantage of the 1031, because they don't know if it's going to still be available in January 1 of next year, depending on the outcome of the election. And so that's one, obviously, big question mark up in the air. But one of the things we try to do is 1031 exchange, so we can avoid that recapture and just continue to defer it. Because right now, the way the tax code reads is that if we can continue to defer that capital gain via a 1031 exchange model, then we can continue to 1031 exchange until we die. And then when we die, it passes over to our heirs, and the basis in the property resets to the current value of the property when we die. And so that actually completely avoids that capital gains altogether. And so there's a lot of benefits to it when it comes to that particular result. But you are correct that if so somebody in the highest top tier tax bracket that's getting that 37%, but when they get that recapture, if it's going to be long-term capital gains, they're going to still be in a better position of having a lower tax bracket when they exit that property instead of being in a higher tax bracket. Depends on if it's being sold in the short term or long term. You have short-term gains or long-term gains as well. Let's see. Yes, we will be resending. So we will send out a recording of this webinar. So just stay tuned for that. What made you choose Lanzaro over the real estate CPA? So I actually had a personal connection with Lanzaro. So I've actually shared the stage with him a few times, spoken on at an event before with him, and chose him just because of that relationship that I had with him. So I wouldn't necessarily say that there's anything that I know of the real estate CPA does wrong or bad that I don't like about them. So I like that group quite a bit as well. I just have all my stuff right now with Lanzaro. all right, I have invested in several multifamily deals using my IRA. I have several K1s with huge losses. Do I need to report these K1s on my tax return? And can I capture those losses even though they are under my IRA? So the answer is no, you cannot use those. And the K1 losses should actually be listed in the name of your IRA with the tax ID of your IRA self-directed custodian. That actually will go straight through to them. And they you would not be able to take advantage of those within your IRA because you cannot benefit with your IRA financially. So you would not be able to take those personally into your own personal taxes if you're investing through your IRA. That would be exclusively just for the IRA. Let's see. Could you discuss again the deferring of taxes through the 1031 exchange until we pass? What happens after we pass the assets on? So just to recap that. So if we can continue to 1031 exchange, which means when we sell an asset, the gains, actually all the proceeds from that asset, the equity plus the gain on that can be moved into the next asset and purchase another asset. There are timelines involved. So you have, there's a 45-day identification period and there's 180 days where it has to be transacted. And as long as you follow in those guidelines, then you can actually defer even further those capital gains into that next asset. And if you can continue to do that until you die, when you pass your when you die and it all passes over to your children or to your heirs or whatever, the basis in that property is going to reset to the current value of the property when you die. So essentially, you're going to be paying zero capital gains tax on that. Neither will your family when you die, because that will reset to the current value of the property when you actually pass away. That's the way it is currently written. And let's see, using SOLOC to buy property is smart at tax purpose or not, due to cannot let investor to involve the property manager, such as, really, I'm not really sure what that means, Dwayne. So I'm not really, maybe it was a voice text or something, because I'm not understanding what that question was. So we got one last question here, and I'm going to answer this for Mama. This was, how has your underwriting changed due to COVID? So real quick here, I talked about earlier about this particular project, which was the Braxton Carey Weston deal out of Raleigh, North Carolina. And this one's open for accredited investors. And I'm going to tell you a few things that we did on this particular deal. So this particular project is a project where the returns normally with our normal underwriting model, they were, 17, 18%, IRR on a 5-year hold. So the annualized was 19, 20%. And we looked at that and we were like, that's great, but we're not pre-COVID, right? We're in the middle of COVID. And so we had to do things like expanding how long it would take to renovate the property. So we're only renovating 50% of these units. So it's going to probably, normally it would take us about 12 months to do that, maybe even shorter than that. But we looked at the numbers and we were like, you know what, because of COVID, let's extend that. So we went from 12 months to actually 20 months of stabilization on this one. The second thing we did is we normally have about a 5 to 7% vacancy during the renovation period, and we expanded that to 9% vacancy during the renovation period, just to again mitigate some of that risk of what could potentially happen because of COVID. Now, all of the stuff that people ask me about, what happens if COVID hits again? Well, a lot of that's going to be short term in nature. We're not looking at this deal as being a short term deal. We're not going to sell in the next 6, 9, 12 months. The goal is to hold on to this deal for that 5-year plan to be able to fully realize the benefits of that property. And obviously, if we can sell it sooner or do a refi and pull out some of the capital sooner, then yeah, of course, that's going to be a great thing for the investors. But when it comes to underwriting, we have to take a lot of those things into consideration. And then one of the other things that we did is we make sure that we raise enough in operating reserves. So this particular deal here, it's a $57.6 million acquisition. So you can see here, the purchase price is $57.6 million on this property. And we're raising $21.5 million to be able to acquire this asset. Right now, it's September 29th at 11:37 a.m. Eastern, and we're right at 80% funded or committed on this particular project. And so the reason why I bring that up is because one of the things that we do on this is we make sure well, I don't want to say we over raise, but we raise, and we're raising 1.7 million plus in operating reserves for this property, because we want to make sure that, again, we can mitigate any type of downside potential risk. We don't have to worry about any type of future capital calls in the future because of this property. And so a lot of that is kind of baked in and kind of built into this particular property, so we can make sure we can mitigate some of that downside risk. All right, one last question. It says, what is the maximum available to invest in Braxton? So the maximum is usually between about 3 to 4 million. So a lot of it just depends on, when it comes to that 3 or 4 million space, it really just depends on, let me just repost this real quick from Julie on the Real Estate CPA website. Question. Let me go back to the question. So the $3 to $4 million maximum investment for each property that we do is really based on the lender requirements, because they will require us to have all the investors under a certain amount, and so usually that maximum amount is between 3 to 4 million. Sometimes a little bit more, sometimes a little bit less, but it just depends on the size of the property. So, but our minimum investment is $50,000. So if you have a $50,000 you want to invest, we'd love to have you on here. It is a 506c offering and only available to accredited investors. All right. So, and I know a couple of you have been asking questions about returns and things like that. So if you're an accredited investor, I would really encourage you to go to this website. I have typed it in here, the chat box once already, but you can go into there and fill out the form. And when you fill out this form here, you will receive an email, and it'll give you access to the document that'll explain all of the different return metrics and the sensitivity analysis. And it's about a 60-page investor offering memorandum that you can review, and it'll go into a lot of those details. If you have further questions, my contact information will be on there as well, and we can jump on a phone call to be able to have that one-on-one conversation with you as well. So thank you so much for being here on the webinar today. Let me see if we have the next webinar updated for next week. So, let me see if we can change this here. All right, so here is the next one. So this is next week. It's going to be understanding the internal rate of return on apartment syndication. We're going to be talking about what is the IRR and how is it calculated? What's the difference between the IRR and the ROI? How to increase your overall IRR? And then how does the IRR compare to the AAR, which is the average annual return? So we're going to go into details on both of those things and go into them very, very detailed. So next week is going to be next. It says Thursday, but I'm pretty sure it's actually on Tuesday. So let me just double check here. Next week. Looks like it's actually on Thursday. So yes, that is actually on Thursday next week. So next Thursday, we're going to be doing this at 12 o'clock. Looks like on the screen here, 12 o'clock. So if you want to go ahead and register for that, you can. Let me go ahead and type in this real quick so we can get the link over to you. You can go to multifamilyinvestornation.com and type in MFI and webinar after it, but I'll go ahead and take this right here. So multifamilyinvestornation.com/MFI and webinar, and you can jump on there and we will go over this topic of understanding the IRR on the next webinar. And for those of you who have not already done it, I would encourage you to go ahead and jump over to our YouTube channel. So if you go to this website, there's a little link right here. It says YouTube. If you click on that, it'll bring us over to our YouTube page, which is listed right here. And I would encourage you to go ahead and subscribe to our YouTube channel, because when you subscribe, you'll be notified of some of these future videos that are available to everybody, and that we do every single week on various topics. So make sure you jump over there, and looking forward to seeing you next week as we dive into the IRR.